So, Simon, Swarup, welcome.
Thank you.
Thank you.
We're here talking about fintech, and one of the things I've thought over the past year or so is I'm actually hearing the word fintech less and less. This is just kind of technology that is becoming integrated into kind of traditional financial institutions. You hear it more talked about as digital finance or just finance. It's the kind of classic sign of a maturing industry. But this is happening as the global backdrop has become a lot more fractious. We've got quite a lot of macro headwinds. We've got a great deal of uncertainty, which, as everybody knows, is the opposite of what investors like when they're deploying capital. And generally, the kind of the economic environment has changed a lot. Simon, perhaps I can start with you. What are the kind of biggest macro trends that you're keeping an eye on at the moment, and how do you think they kind of interact with this fintech sector?
Well, first of all, Joshua, thank you for the invitation. And your own scene setting, I think, picked up on a couple of those big macro trends. The first one I would cover is the cost of capital environment. Part of the reason why we've seen this slowdown in fintech investment is actually not any ideological shift away from its centrality to payments, to the evolution of financial services. Not at all. In fact, if anything, the behavioral adaptation into people's lives, into financial services, core businesses, is accelerating in extraordinary pace. But capital deployment is having to respond just to a very, very different global cost of capital environment to the one where a lot of these businesses were founded. And that manifests itself in two ways. First of all, the way in which funding rounds are secured. Valuations that were secured in the early 2020s when the default cost of capital was close to zero are very different where the global cost of capital is 4 or 5%. But also, secondly, the remuneration packages of some of the entrepreneurs, some of the workers, there's a huge battle for skills. Some of those are locked in to pre-existing compensation packages, which make it very difficult for labour mobility to happen. So as a result, you've got something of a static ecosystem that has emerged as a result of that direct change in something beyond the fintech sector's control, which is the global cost of capital. And then secondly, in terms of the big global trends, it is whether in an environment that has been allowed to build up with relatively little friction, whether geopolitical poles in China, in the United States, in Europe, in the GCC, are starting to look, and I suspect we'll come on to this later in the conversation, look at whether being totally agnostic of control over regulatory standards, over the underlying assets, the regulatory perimeter, whether that is going to be optimal for economic governance, for demand for underlying fiat assets, government debt, some of the elements that are integral to a well-functioning financial system.
Now, you've hit on something there that I want to talk about more, because you're talking about the kind of increased cost of capital, questions about demand for government debt, the kind of furious amount of issuance of government debt over the past few years is perhaps the main factor that's driven up the cost of capital. But there's another way that this interacts with the fintech system, right? It's not just it's not just driving up the cost of raising funds. It's also interacting with the new stablecoin industry. This is a new kind of source of demand for some kind of short and even longer dated government debt. How do you see that kind of dynamic playing out? You know, it's become reflexive, right?
It has, and most saliently in the United States, which again has been on the front foot here of recognizing the interdependency between a healthy stablecoin ecosystem and the underlying demand and liquidity for its debt. Now, that is reducing average duration of government debt, which has big macroeconomic implications, particularly when you're looking to have long dated public sector investments and you're issuing debt that is short dated. But is this, and perhaps this is the success of stable coins of payments as the marginal provider of liquidity in that market, is that forcing duration to shrink, because that actually is the more, if you excuse the alliteration, it's the stable part of the stable coin asset base. And actually, therefore, there are huge macroeconomic implications of risk on public sector balance sheets that are intrinsically linked to this evolution of the stablecoin ecosystem.
Yeah, and I find it interesting that that's coming just as the kind of the temptations to governments with high deficits for issuing short over long-term debt are particularly high at the moment, in the hope that they can get that lower cost of capital, and they've got this new source, so maybe some risks there. Now, Simon brought up geopolitical tensions. Swarup, I know this is something that you've looked at a lot, and it's a third aspect of the macro backdrop, because we're seeing trade and tariff and all sorts of other barriers go up at the same time. When you look at geopolitics at the moment and its kind of relevance to the financial system, what are the biggest areas you're thinking about at the moment?
Thank you, Joshua. I think that's a good segue for me to come in with my bit. The current state of geopolitics is such that while we had risk in the past and methods to hedge risk, which most people in the room will know much more about than I do, we now have uncertainty and less risk, which is even more or less quantifiable than risk itself. You can hedge against risk, but you can't really hedge against uncertainty. And we've talked about the cost of capital for a bit, but what that manifests in practice is that long-term risk premia is going up, right? So bond yields are going to spike again and again because, as Simon has mentioned, government debt is piling up. And the reason for that is that, economic and defense policy has changed. And that has changed again because trade policy has changed because of the trade barriers that President Trump has brought in. And so you have a large part of the world indulging in industrial policy, which has never had to for a long time, and also boosting its defense spending, leading to a massive spike in bond yields and debt servicing costs that are becoming absolutely unsustainable. So that's one aspect that's not particularly good news. The other issue, of course, is that efforts are being made, and I'm sure you'll come to that in a bit, to move away from the US-dominated dollar-based financial institutions-based system, because that system wasn't just based on the good faith of the US dollar, but also its free institutions. As you can see, we have a lot of interference or supposed moves at interference into the independence of those financial institutions. And therefore, large parts of the world, such as the BRICS countries or other regions that were still heavily dependent on the US dollar and will remain dependent on the US dollar for the foreseeable future, are trying to find ways and means to diversify away from them. And the most easy way that's manifested in is kind of wholesale transactions, such as oil for wheat, and so on and so forth, commodities transactions, where you have these preset arrangements of how monetary exchanges happen. So you have two major issues going on. One that Simon's mentioned, you've talked about, is that it's government debt in particular is getting unsustainable, risk premia is rising, and on the other hand, there are slightly more hastened efforts to move away from the established global financial monetary system that has existed for the last 50 years.
Now, you've talked there a lot about challenges, and I don't want to get too kind of doom and gloom, because in the way things are developing, there are also opportunities.
Of course.
We're seeing kind of geopolitical blocks that once entirely set the rules for the financial system, and obviously thinking particularly of the US, maybe having less sway over the rest of the world as people consider de-dollarizing, as you get these kind of new fintech hubs like here in the Middle East. Yes. that are growing up. Where do you see the kind of, from a regulatory standpoint, where do you see the kind of opportunity for regions like the Gulf?
Absolutely. I think you now have a clear diversification or divergence of the kind of regulatory regimes. So you have the so-called enabling regulatory regimes, the kind that Mr. Trump is trying to set up for stable coins and through his Clarity Act and Digital Assets Act. And then you have slightly more restrictive regimes like the Hong Kong regime, which is trying to do more about fraud prevention and AML and CFT and getting KYC in place. But here in the Middle East, you have this beautiful situation where you have both private and government players coming together to create the kind of environment that's needed for innovation to foster. And you see great alignment of regulatory standards across the region. You still don't see one single bedrock standard, which is probably something that's ideal or not. But you do see great alignment. You see lots of interesting sandboxes where fintech players can come in and do their work. Here in Bahrain itself, you have JP Morgan coming in with its own Onyx stablecoin. You have Project Aber, that's the wholesale stable coin that's being exchanged between the UAE and Saudi Arabia. So you have three kinds of situations, I guess. One is slightly extreme, which gives a kind of enabling environment, but a laissez-faire kind of situation, which is the United States. The other one is more Hong Kong, sorry to use that word again and again, which is slightly more restrictive. And you have a sort of best of both worlds. You have government players where needed, and you have the freedom and the ability and the innovation that private players can bring in order for fintech to really foster.
In this environment, we've talked a bit about stablecoins already because they're sort of such an important part of the sector that's growing up. But a lot of countries have a desire to de-dollarize at least a little bit, to become a little bit less dependent on US assets. And yet at the same time, as we see new stablecoin issuance, I think something like 99% of the assets are going into dollar stablecoins. Mm-hmm. Simon, how do you see that developing? Is this a technology that is actually entrenching dollar dominance, or is it an opportunity for people to kind of move away from it?
Well, there's a friction at the heart of that desire to de-dollarize, which is if you incentivize flows of capital back into your domestic market, all else being equal, you will generate an appreciation of your own currency. And the theme of the last quarter of a century really have been huge trade imbalances fueled by weak currencies, fueling export surplus countries, largely playing off an ever-increasing trade deficit in the United States and sort of, to a slightly lesser extent, the UK and India. And what you have is a situation where if stablecoins facilitate something of a shift back to underlying fiat asset, be the currency or the short-dated debt instrument in that currency, in that domestic currency, you actually change the terms of trade arrangement, which we'll hear, I think, later at the conference from the central bank governor of Bahrain. And I think for all central bank governors and indeed fiscal policy makers, and my home economy of the United Kingdom, our central bank governor Andrew Bailey's talking a lot about the challenges of stable coins to the monetary transmission. So it's not just the exchange rate, but it's also the impact of fractional reserve banking, the impact of the central bank policy instrument, or instruments as now are, to influence financial conditions. There are, if you like, conflicts all over the place. And I think to conclude that there's going to be, if you like, a real shift away from the legacy of dollar assets dominating that may happen for geopolitical strategic reasons, but it will have a very, very significant impact on the underlying competitiveness, actually, of a lot of the counterparties to the United States economy.
Yeah. And thinking of kind of, in this environment, thinking of the fintech firms themselves, what do you see as the kind of hallmarks of the sort of industries that are going to thrive in this background versus the ones that will be overwhelmed by it? You kind of started by saying a lot of the investment has been at kind of 2020 valuations that were particularly high. So there's clearly a vulnerability from that perspective. But what kind of determines success or failure for fintechs in this environment?
We've focused a lot on the fin part of fintech. Let's cover the tech part of the word. And what has very clearly emerged in technology subsectors is a winner-takes-all market structure. And you would expect, and certainly the first wave of fintech investment has certainly moved in that direction. The idea of scale, market primacy, that race, heavily capital-intensive race adoption of customers, had really defined that. And yet now it feels like investors are asking themselves, how realistic is that in what Swarup is talking about, the geopolitical context, where actually we may be about to, and I suspect we are, going to be much more an era of national or regional champions. And so the tech model of winner takes all still holds, because I think there are good economic market structure, business formation reasons why that is the most efficient system. But will it fragment? Probably down half a dozen regional poles. I think that's most likely. And therefore, most investors are asking, what's going to be the regional champion, not just in stable coins, but then in terms of a platform on which a multitude of financial technology services emerge.
Yeah. And
China is probably the country that is most advanced in that regard. I suspect we will see that emerge.
Interesting. Why do you say that it's the most advanced?
If you look at China, China has recognized both the advantage of technology scale, but the importance from a regulatory standpoint, and this isn't just financial regulation, but societal regulation, of having a single point of regulatory access. A federated system is far harder to control. One that is concentrated around a single platform with many nodes is much easier for a regulatory system that wants a little bit more control of the flows of capital and information on what is going on.
It's kind of interesting that what is in many ways a more restrictive regulatory regime can also be a bit clearer and can make it kind of obvious what firms can and can't do and what investors should expect from them. We're also talking in this conference about integration. Swarup, how do you see this? This has been such a kind of disruptive, fast-moving sector. If we were here kind of a few years ago, you'd often perhaps have traditional financial institutions talking about the importance of fintech, but maybe slightly grumpily wishing that it hadn't happened and wasn't kind of disrupting their business model. Now we are seeing those insurgents more and more kind of integrate and kind of become part of the old guard. What do you think that's a sign that fintech has lost its edge, that it's no longer so edgy, or is it a good sign of kind of the industry maturing?
Yeah, I think that's a lovely thing to say, and I'd like to take you a bit through the kind of short recent history of how these things developed. So, about 3 years ago, you had the super apps of the world, some of the super apps that perhaps Simon was alluding to,
Yep.
Especially in China. And then you had the idea that there would be this fintech super app. And then you had this clear situation where there were the so-called staid TradFi companies or traditional finance, and you had DeFi or decentralized finance on the other side. But now you have traditional finance of the likes of JP Morgan coming up with some of the more exciting fintech ideas, and you have some of the more DeFi players being burdened by a regulatory regime which they worked towards building in the first place. So you have a interesting mix of situations where you have a lot of traditional financial institutions building these incubator kind of situations for fintech growth and fintech innovation. And you have older fintech institutions, the major stable coins and dollar coins of the world, I'm not going to name them, who now find themselves burdened under anti-money laundering, combating finance of terrorism, know your customer kind of norms. So it's not the end of fintech, but definitely the maturing of fintech. And I think we're on the cusp of something far more exciting. But the issue now is that scale is important. You need to have the ability to scale quickly in order to service customers in various ways. And at the same time, not just deep pockets, you also need to be innovative about how to do it. I'm not sure whether this is the right segue to talk about it, but you might soon have very large retail players, online players, thinking of issuing their own stable coins or their own monetary integration technologies, which will bypass all kinds of layers. And just to end this particular bit, though you might go on a bit about that, add to that something like AI or Gen AI, and then you have the ability to seamlessly select, purchase, even have selected for your product, and then purchase and then immediately transact. So you have the kind of interesting innovation because of 3 points in play. Traditional finance coming close to fintech, older fintech players trying to play catch up with regulations, and then the super apps and the very large retail players of the world adopting some of these and other new technologies in order to provide this seamless customer experience.
I'm pleased Swarup mentioned customers, because there's a danger sometimes these conversations can forget about the most important node of all, which is the customer base. And sometimes the conversation at the moment about fintech integrating itself into traditional financial services is looked through quite a negative lens of cannibalization of the traditional financial sector players looking to either stifle innovation or bring it into their existing model. I see it very differently. I think the innovation is fantastic across the sector, but it does need to dock into those who have shown through the cycle that they're successful in terms of customer acquisition, customer service, the element that sometimes gets forgotten, but actually is integral to the long-term sustainability of any product. And from my day job at Panmure Liberum, we see a lot of investors at the moment saying, the cost of customer acquisition is one of the big barriers to the next stage of development. If you can integrate your offering with someone who has shown their ability to do that at scale, at low cost, at competitive cost, there is your opportunity to take a product which is innovative, adds economic value, is more productive, and docks it with someone with an existing customer base or great expertise at servicing customers. And that part is probably the most exciting part of, let's say, FinTech 2.0, if that is the version we're in now.
How important are new payment rails for integrating fintech with the broader financial system? And I'm thinking of several potential options. I think the incumbent options are, for many people, unsatisfying because they're too expensive. There's been a lot of discussion of central bank digital currencies as perhaps needed for settlement of digital assets. Now it seems the private sector is coalescing a lot around just using stablecoins, the more reputable stablecoins, in order to do these things. What needs to be done to actually integrate digital assets with the rest of the financial system?
Yeah, I think this may be a little premature, but it's a good point. It's a good time to set the stage for this. I think generative AI will have a large part to play in all of this. We have an API-based system currently, which acts as a sleeve for information and also a sleeve for permissioning. And whether it's a fast payment system, it's a stable coin, it's a set of tokenized assets, it's a CBDC, all of them use an API layer in some way. But once you have agentic AI thrown into the mix, you have something that's emerging called Model Context Protocol. So that's a system where you have agentic AIs talking to each other. So you have various cash flow integration possibilities, treasury management possibilities, and of course, payment exchange possibilities, which were not possible before, which reduced cost because they reduce the cost of verification, they reduce the cost of securitization, and all kinds of other issues that existed in these systems. So, there's a healthy mix that's going to develop because of this. You have fast payment systems, you have stable coins, you probably have wholesale CBDCs as well, and you have other exciting payment rails that you've talked about, including ones that are run by large retail giants or other kinds of giants that are online players, and you have an interesting mix of these. But you have the kind of automation that's possible without constant human intervention, which makes these much more cost-effective than they earlier were because of the rise of things like agentic AI.
Thank you very much. I think we are running out of time. So a very quick question. 5 years ago, I'm not sure that I would have guessed that one of the biggest topics we'd be talking about was stablecoins. Now, I don't think that was so much in the water supply. What do you think the next kind of big change agent is going to be for the fintech sector?
The next big change agent for the fintech sector will be tokenized assets. It will be how even central banks across the world, there are some in Eastern Europe, are already adopting tokenized assets, such as some stable coins as reserves. And that enables the kind of settlement times and the kind of, again, cost reduction and lack of human intervention that wasn't possible even maybe a couple of years before. I'm pretty sure next edition, that will be the topic that you'll be asking us about.
Simon, Swarup, you've set the scene on kind of a huge range of issues and kind of the world economy and the entire fintech sector in 25 minutes. So thank you very much. Thank you for joining me.
Thanks, Josh. Thank you so much.
Thank you.
Thank you.